everyone. We are from Group Heavy Invest. My name is Syahrul Ramadan.
Hello, I'm Renward Sinaga.
Hi friends, my name is Erlando.
Hello everyone, I'm Endy.
Here is our highlight of book by Peter Lynch with title One Up on Wall Street: How to Use What You Already Know to Make Money in Market. In the world of investing, the complexity of investment options can jeopardize the integrity of portfolio and lead to potential financial loss. This is the situation we aim to avoid. Instead, our goal is to achieve gains and profit. To navigate this landscape successfully, it is crucial to have a strategic understanding of market dynamics.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it.
Lynch, a respected fund manager, highlight the inherent advantage individual investors have over professionals. His practical approach emphasizes the importance of personally understanding and comprehending chosen companies. Our first key takeaway is determine the types of companies. Before we embark on investing, it is essential to conduct research and analysis each stock we plan to invest in by familiarizing ourselves. We need to focus on the company, not to the stock. A strong portfolio, we must have a better understanding of the stock we want. In general, several important things to pay attention to include uncertainty about short-term market direction and long-term stock potential, such as: first, inability to predict the stock market. The idea that accurately predicting the future of the stock market is impossible, emphasizing that even experts often fail in this regard.
Actual bad economic news, rising interest rates, wars, elections, any of these can push the market down. If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock market is going to do next, you are wasting your time. No one can predict the market.
2. Cocktail party theory. The cocktail party theory, observing that when people extensively discuss stock at social events, it could be an indicator that the market is about to turn. Third, investing in great companies. It is better to focus on investing in great companies rather than attempting to predict market movement. The performance of individual companies is deemed more important than overall market dynamics. 4. Importance of intrinsic value. Urging readers to pay more attention to the performance and intrinsic value of companies rather than the dynamic of stock market. 5. And the last one, not chasing short-term market movement. It is advisable to ignore short-term market fluctuation and focus on long-term growth potential.
Takeaway from chapter 6 to 9. If you like the product or stores, chances you are the love the stock. If you are engineers, finance, professional athlete, teachers, you have edge over the money market. We all have certain industry, product, and services that we know more about the average person does. Perhaps we know more about the construction industry because we work at the construction company, or perhaps we know more about the gaming industry because we consume game ourselves as our primary leisure activity. The point is that we have value information about the public listed company through our everyday life. And this information that Wall Street or IDX either doesn't know yet and had to spend hundreds of hours of market research to realize. Peter Lynch famously said that if you like the store, chance that you will love the stock. Think about it. Which product do you enjoy and use from public listed company? Here is some of mine. Gojek awesome local app service. I have completely addicted using this app lately, and I'm probably using this app every day. So I spend more than 3 million rupiah every month. We are looking for investment opportunity this way. You must always remember to check how much the product or service that you enjoy affect the bottom line of the company. Peter Lynch argued that there is a 6 different category of stock investment. Number 1, slow growers. This company is typically large, operate in nature industry. The growth of the company is expected to be in the low single digit of percentage. Number 2, stalwarts. The stalwarts are in the betweeners. An earning growth rate of 10 until 12% per year is a standard for this category. Number 3, fast growers. These are aggressive new enterprise growing at 20% or more per year. Number 4, cyclical. Cyclical are companies whose revenue and profit rise and fall with the business cycle. Number 5 is asset split. They are firms that might have value asset that you didn't know thing in the market pricing. Number 6, turnaround. The turnaround are potential fatality. Company with declined earning and problematic balance sheet. These 6 categories are explained in much greater detail in the book. When using this category, you must understand that company can belong to more than one of them at once. Also, company don't stay in the same category forever. Another takeaway from chapter 8 to 9. Here are 10 positive signs for a stock. Number 1, the company name is dull. Or even better, ridiculous company tend to be overlooked. Number 2, it doesn't something dull. Number 3, it does something disagreeable. Better than doing something dull to do something disagreeable. Number 4, institutions don't own it, and it is not followed by any analyst. Such companies have not been discovered yet by big boys, which give an extra potential upside. Okay. Number 5, there is something depressing about it. The Burger Company service is a classic example. Number 6, the company industry is not growing. In the high growth industry, thousands of people are constantly thinking about how they can grab a part of the market shares. Number 7, it got niche. There are companies with the most of Warren Buffett famous looking for. Number 8, it has recurring revenue. The product, a subscription or something that consumed so that the customer are forced to return for more. Number 9, insider are buying. The insider know more about the company than anyone else. Number 10, the company is buying back share if the company has faith itself. It should invest itself. Peter Lynch preferred to share buyback for dividend.
Chapter 11 of this book, it says if a company consistently pays dividend, it may be a stable investment. Look for a company that has not reduced or suspended dividend, especially during the economic downturns, because this is one of the signs of a good company. We need to assess potential for continued fast growth, evaluate the value of the company asset, considering factors like stock price versus the value of specific division or real estate. Chapter 12, we need to meet company representative either in person or at annual meetings. It can provide us valuable insight. The author also shares example of encounter that influence investment decision, kicking the tires, practical analysis. The author emphasized visiting store, trying the products, and observing customer behavior. This approach supplements the quantitative analysis of financial reports. Reading annual report for sure also emphasizes the importance of a holistic approach to investment, combining both quantitative and qualitative analysis to make informed decisions. Chapter 13, the relationship between its stock price and earning ratio, the impact of its cash position, the significance of its debt structure, and the role of dividends, the potential risk associated with excessive corporate cash and debt, providing the comprehensive overview of key consideration for investor in the stock market. So, the investor will need to monitor or control the excessive corporate cash and debt. Very important. Chapter 14. Investor to remain vigilant and adaptable in their approach. The section concludes with a reflection on missed opportunities and emphasizes the importance of leveraging industry dynamic and competitors' observation for informed decision making overall. Chapter 15. Monitor the speed of expansion. Assess if the company can survive creditor rates. Look for signs of restructuring and divesting unprofitable division. And also be patient and avoid impulsive decision which is maybe counterproductive. Dedicated time to thorough research. Thank you.
In the third part of this book, Peter Lynch divided in 5 chapters which were focused on strategies for long-term investment success. This section is particularly valuable for readers who are interested in developing a sustainable approach to stock market investing. In the chapter 16 about portfolio design, let's start by breaking down portfolio design. There are 7 points must be noticed. There are 1. Realistic return expectation. 2. Cost and performance evaluation. 3. Comparison to index funds. 4. Portfolio diversification. 5. Trading costs and strategies. 6. Stock categories and risk management. And 7. Selling strategy. In chapter 17, it talks about market dynamics and timing. It then tackles market timing, arguing its future exercise. It advocates for focus on fundamental value over trying to capitalize on market swings. Some points that we can resume from this chapter consist of 1. Not perfect timing for buying. 2. Opportunistic buying periods. 3. Selling strategy. 4. Personal experiences. 5. Influence of market noise. 6. Specific advice for selling. And 7. Asset-based strategy. Chapter 18 Lynch explain about myth and misconception in stock investing. Lynch debunks common investment myth. He emphasizes that stocks always bounce back and highlights the importance of research over speculation. He also describes the 12 common but misguided beliefs about stock prices, providing valuable insight to investors to avoid these pitfalls. For chapter 19, it's about risk of complex investments. It warns against complex strategies like option and short selling. We can find some key points. There are 1. High risk and complexity. 2. Limited utility and high fail rate. 3. Short selling risk. And 4. Portfolio insurance misconception, where he critiques using option and future as insurance. In the last chapter, in chapter 20, talking about global events, impact, and psychological aspects, the author also delves into how global events impact the stock market, offering insight into navigating these external factors. An interesting part is where Lynch discusses the psychological challenges in investing, like the herd mentality and emotional reaction. We can find and simplify this chapter in 5 key points. They are 1. Historical events and market reaction. 2. Market trends and dynamics. 3. Changing market landscape. 4. Impact of financial news, where media corporate influences the stock market. And 5. Investment advice encourages viewing market declines as opportunities and stresses long-term investment perspectives. This part of this book is particularly insightful, offering a wealth of knowledge on portfolio management, market dynamics, and the pitfalls of common investment misconception. Lynch's advice is rooted in practical experience and presented in an engaging, accessible manner, making it must-read for investors seeking to build and maintain successful investment portfolios over the long term. The book empowers readers with the knowledge and tools to navigate the complexities of the stock market with confidence, a more informed perspective. This book, One Up on Wall Street, is an invaluable resource for anyone looking to understand long-term investment strategies. I think that's all. Thank you very much.